Good day. Welcome to WEC Podcast. The Women in Ethics and Compliance Global is an international and professional organization where our mission is to empower women in their personal and professional goals with a focus on ethics and compliance by providing a community where they can share their experiences, learn from each other, and grow professionally. We are an inclusive organization where men and others are very welcome to become a friend of us. I am your host today, Josefina Maggiari. I'm the Vice Chair and Director of Events and Education of WEC. In this episode about tax reporting in the sharing gig and crypto economies, our guest speakers will address a comprehensive overview of the growth and impact of the sharing gig and crypto economies. Indeed, the rapid expansion of these sectors has brought a lot of benefits to society, including increased convenience, accessibility, and economic opportunities. However, it has also given rise to certain unintended consequences that require careful consideration and regulation. The functions of a compliance officer in companies are closely related to the implementation and adherence to legal frameworks and policies in the digital economy. Compliance officers play a critical role in ensuring that businesses comply with laws, and in the context of tax compliance in the digital economy, the role of compliance officer becomes even more crucial. I must confess that I will enjoy this podcast like no one else because I'm dedicated to tax transparency, and I have the honor of having two experts in the field, researchers and great professionals, to share their knowledge and experience with the entire WEC community. Juan Manuel Vázquez is a PhD researcher at the University of Amsterdam and the academic coordinator of the research project Cashless Platforms Technology, CPT, of this university. He also works as a lawyer in the firm Loyens & Loft in the Netherlands. And Dr. Claudio Cipollini, assistant professor in tax technology at the University of Amsterdam, with a special focus on distributed ledger technologies, including blockchain. He is one of the research leaders of CPT project. He's also a tax lawyer admitted to the Italian Supreme Court. Juan Manuel and Claudio, can you share with us some brief considerations as kickoff of the topic, considering how governments and multilateral organizations like OECD and are dealing with the challenge about strike a balance between encouraging innovation and economic growth while ensuring a fair and transparent framework?
Thanks very much, Josefina. First of all, we are very happy to be here, so we thank you and the organization for inviting us. So just to kick off, at least with the part of the sharing and gig economy, which is the one that I will be addressing today. The platform economy is something that has emerged in the last 10 years. It's not something new, but something that we all deal on a daily basis whenever we purchase something via a marketplace or whatever. We need to get a lift from some place to the other, and we order via an app, or whenever we go on holidays and we would just want to rent an apartment via one of these famous platforms. So the phenomenon is not new, but somehow the emergence of the sharing and gig economy raised an interesting issue in the field of taxation, which in the beginning was mainly focused on how to tax these big businesses, like how to tax the GAFA, the Google, Amazon, Facebooks of this world. But next to that important topic that is being currently discussed still at the OECD level on the taxation of tech giants, there was another emerging problem, which is the one that all these tax transparency regimes that we're going to talk today are looking to, which is basically how are we taxing all the underlying activities that these platforms facilitate? And by the underlying activities, I'm referring to how do we make sure that people renting their apartment via Airbnb, or people making extra money by driving cars using Uber, for example, how do we make sure that these little taxpayers that maybe they don't have a big tax responsibility, but when you accumulate the number of income that they get, it becomes significant for governments. How do we make sure that they comply with the relevant tax liabilities? And that's the topic that I'm going to address today. Basically, how do these new regimes adopted both at the European level and OECD level address this issue?
Perfect.
Yeah. Yes, thank you much, Josefina, for this invitation today. It is a pleasure to be with you. And well, if I can add something to kick off this this meeting, this podcast, I would say that today we have to focus our attention on the last initiatives from the OECD and the European Union, because we will especially focus today on the last initiatives from the European Union. And we see that these organizations have taken the leadership on the initiatives to be adopted to address the new issues and new challenges of the digital economy. And I would say that the underlying motivation for these initiatives is the idea of tax fairness. The basic of this initiative is always to ensure that even in a new technology-based society, we still be committed to the respect of the principle of tax equity, and therefore to have an equal treatment of taxpayers, both for the taxpayers that are involved in the use of new instruments, such as, for example, investing in cryptocurrencies or other blockchain technologies, and all the other taxpayers that are still focused on more traditional instruments for their investment.
Very clear. So why new tax transparency rules for the sharing and crypto economies is important for the economy? Why
so maybe starting with the sharing economy, and then I let Claudio explain the crypto part. But basically, we have to think that there is no discussion about whether, let's say, the services supplied by Uber drivers or the income that Airbnb host gets because of renting its apartment, that there is no discussion whether this income is taxable or not. It is clear that they should pay taxes for that income, and where should they pay. That's not the discussion here. But the thing is, there is a compliance and an enforcement challenge here, because the existing frameworks for exchanging information among countries and even domestically, but that governments use to get info and kind of contrast this info against the auto declaration of taxpayers, were so limited that they did not include the information of these transactions that were happening online. You have to think that many of the taxpayers making income through the sharing and gig economy may rely on foreign platforms. So basically, the existing legal frameworks like CRS in the US, FATCA, or all in the EU, the DAC, the Directive on Administrative Corporations, did not cover this element of income, basically income coming from activities facilitated via platforms. So there was a gap there to be covered, and basically governments realized that administrative cooperation frameworks were limited, that there was a growing amount of income in that sector that was not only generating tax revenue losses. And to give you some numbers, for example, in the EU, the tax gap in 2018 was estimated between 2.7 and 7.1 billion, which could be triplicated by 2025. So there was a big tax revenue loss. And also there was a problem, what Claudio mentioned before, of competitive advantage of some sellers that operate outside platforms and have to pay their share of taxes, and because they are under the radar of the tax authorities, against vis-a-vis those taxpayers that were using foreign platforms to make sales or provide services which were not under the radar of tax authorities, and also had to somehow declare and pay taxes on those items of income. On top of that, there were to address this problem, there was an emergence of many unilateral measures in the whole world, which were completely different one to each other. So there was no harmonization, and this was elevating the compliance costs for platforms. So the multilateral initiatives, both at the OECD level and the European level, aim to somehow address these issues.
Perfect.
Yes.
Yes, Claudio.
If I can just add something, the basic idea in the end is that before approaching the tax issues, before exploring really how to tax in detail this kind of new activities, it is really necessary to ensure that we have enough information available. So the first point is the availability of tax information. Then we will have time and space to explore and to deepen the tax treatment of these new situations.
Yes, yes, absolutely. And in a glance, what do this framework introduce?
Well, on the side of DAC7 and the OECD model rules, basically they introduce a standardized tax reporting requirement for online platforms. What does this mean? It means that platforms, digital platforms of the sharing and gig economy, but we'll see later on that they are not limited to these platforms only, but they have to collect, verify, store, and report information, personal information of their sellers. So imagine the people renting their apartments or a professor giving lectures through a platform. So there are certain personal information that has to be collected, verified, stored, and reported by the platforms to the tax authorities. And also some financial information about the transactions that they enter into. Once this information has been verified via due diligence processes and reported to the tax authorities should automatically exchange this information among themselves in order to ensure that basically you cannot get out of the reporting by relying on a foreign platform. And evidently, the directive on administrative cooperation, it's called DAC7 because it's the 7th version of this directive. It was the OECD model rules, the leading, let's say, guidance or framework at the global level that were then implemented in the European Union via an amendment to the European Administrative Cooperation Directive. And that's on the side of sharing and gig economy.
Yes, and besides DAC7, we have also today DAC8 in the European Union, which is a specific initiatives for crypto assets, for the world, regulating the world of crypto assets. And there, with this DAC8, we have reporting obligation, and therefore, reporting crypto asset service provider today are all required to report their tax information, and we have also the need for them to comply with some specific due diligence procedures. So this is just in a few words the what these new initiatives of the European Union is going to introduce.
Perfect. And can you briefly explain how the due diligence and tax reporting procedures under DAC7 and DAC8 work in a short?
Sure. So maybe it is important to clarify, like what's before, like let's say how to comply with this, like who has to comply with this, because it is clear. Okay, we were speaking about platforms, right? But yes. So the directive, both directives, but I will speak specifically on DAC7, they provide some definitions on what is a platform and what are platform operators and what are the requirements for them to be obliged to comply with all these obligations. So basically, as an example, the definition of platforms is very broad. So it includes any software, including website, applications, which are accessible by users, allowing sellers to be connected to other users for the purpose of carrying out certain what are called relevant activities. So there are also certain type of activities that have to be facilitated by platforms in order to become reportable. In the definition of platforms, for example, those interfaces that only process payments or just redirect users to a different interface, or only provide advertisement spaces, those are excluded from the scope of the rules. But basically, these rules apply, and speaking specifically about the European rules, not only to European-based platforms. So if those platforms that are based in the EU or have a permanent establishment on the EU or a place of effective management, but also those foreign platforms. So it's important to mention this, because even if you are not in the EU and you operate as a platform by connecting EU sellers, or maybe renting out immovable property, an apartment, think about an apartment or a garage based in the EU, then as a foreign platform, you are also covered by these rules. So you should somehow report. In principle, you should register in the EU unless there is an equivalent regime at your country, and where this ensures that the exchange of information will occur. But it is important to highlight in a nutshell that these rules have extraterritorial effects. So you not necessarily need to be in the EU to be affected by them.
Yes.
Maybe as regards to the scope also, the type of activities that are covered by these rules are mainly which are the rental of immovable property. So think about an apartment, garage, parking spaces. So this is the type of Airbnb business, booking.com business. Also, the supply of personal services. So all the platforms that, for example, facilitate that you want to arrange your garden and you want to hire a gardener to go to your place and arrange it. So any type of personal services that can be somehow adapted or requested by the users through an interface, those are also covered. And there are great discussions, because the definition of personal services are not clear. So it can cover several types of them. The third category is the sale of goods, of tangible goods. So imagine Amazon marketplace type of business models. Those are also in scope. And finally, the rental of any mode of transport. So those are platforms that, for example, facilitate the rental of a car when you're not using it, that you can rent it. So all these type of platforms are the ones covered by this. And there is a requirement that, of course, the activity has to be for consideration. So that whenever you connect a user with a seller, there needs to be a consideration that is known by the platform in order to become reportable. So I think that's in a nutshell what DAC7 covers, and I can then explain how is the reporting done. But maybe Claudio wants to first explain also what's the scope of DAC8, and I leave that to you.
Yes, sure, Jan Manuel, thank you. The scope of DAC8, well, first of all, we have to focus on the concept of a reporting crypto asset service provider, because these are basically the entity over which we have imposed these new reporting obligations. We do not have a definition of reporting crypto asset service provider within the text of the DAC8, but the DAC8 relies on the MiCA directive, which is the MiCA regulation, which is one more important legislative act that has been recently approved by the European institution. And we see there that a crypto asset service provider is any business, legal entity which is involved in the provision of crypto asset services on a professional basis in favor of a third party. But we see also that DAC8 further narrows the scope of this concept of reporting crypto asset service provider, because it limits the scope of application to those providers who permit users to complete an exchange transaction. So therefore, this means that crypto asset service provider that merely provide advisory service are outside the scope of application of DAC8. And I think this is a very important element to remember for the scope of application of DAC8. We see, in any case, that the focus of DAC8 is exclusively on centralized intermediaries. This is very important because in the end, DAC8, the scope of application of DAC8 does not cover the world of the DeFi or the decentralized finance, because we still see that the reporting obligations are required only by centralized intermediaries, which are basically traditional companies which are managed in a traditional way with a central liability, with a central place of management, while all the centralized crypto exchanges that they allow users, permit users to perform transactions based on algorithm or on smart contracts that are outside the scope of application of DAC8. And I think this is a very gray areas of this directive, because in the end, we can raise some doubts about the effectiveness of these initiatives, because we will see that all the world of the DeFi, we will probably remain out of this the scope of application of these new initiatives of the European Union. To understand the scope of DAC8, is also important to say something more on the reportable crypto assets and also on the reportable users. For what regards the reportable users, these are all the users that are resident in one of the EU member states. We have some exclusion because, for example, bank institutions or governments that are outside the scope of application, they are exempt from being considered as users for the purposes of DAC8. And one more thing to say is that when we have those transactions that are made by users in a peer-to-peer manner, so just avoid the use of centralized intermediaries by their self-hosted wallet, also this kind of transactions are out of the scope of application of DAC8. And this is one more gray area that I would like to highlight right now, and to say that I have some doubts about the effectiveness of DAC8 also for what regards this specific aspect. For what regards the transaction, we see that basically DAC8 covers both the crypto-to-crypto transaction, the fiat currency to crypto transaction. So in the end, the scope is quite wide in this sense. Just some more words regarding the due diligence procedures, because in your question, Josefina, you specifically mentioned the due diligence procedures. The most important point is that the reporting crypto assets providers are all required to collect information. This is what due diligence procedures effectively entails. Just by using the self-certification, they have to ask their customers to fill in a self-certification when they first enter into business contact with their customers. So this will be the procedure through which reporting crypto asset service provider will provide all relevant information for their customers, and we collect the information that they have to make available at a later stage to the tax authorities of the country, of the European country where they are registered as a reporting crypto asset service provider.
Maybe to add on that, like DAC7 follows the same logic in relation to platforms, so that the due diligence procedures become key at the moment of the onboarding of the new sellers to the platform. So whenever, in the case of DAC7 that enter into force in 2023, so that the first reportable period is already this year, and it will become due the reporting by the 30th of March of the, sorry, by the 30th of January of 2024. So when onboarding new clients, platforms already are making sure that they collect and verify all these both personal information items like the tax identification number or the VAT number or the commercial registration number if it is a business, right? And also because of how difficult it is to comply with this type of due diligence procedures in relation to existing sellers. In the case of DAC7, for example, there is a different timing for those obligations as regards to existing sellers, which are delayed 1 year in order to allow platforms that have to comply with this obligation to somehow make sure that they have more time to ensure that their sellers that are already onboarded on the platform can provide that extra information. And here we have to think that both for DAC8 and for DAC7, what we see is basically a deputization or a delegation of certain functions from the government to intermediary platforms, crypto or sharing, which if they are not complied with by the sellers, in this case in DAC7, the platforms have to sanction them. So there is the possibility of them to block the account of the seller if the sellers do not provide the relevant information that the platforms are obliged to verify in order to ensure tax reporting. So I think these legislations put a lot of pressure somehow on the intermediaries and also on the sellers that do not want to comply with the requirements.
Yes, it allows tax authorities or other relevant parties to assess the taxpayers' adherence to tax regulation and identify potential risk or non-compliance. So it's so relevant. And what about the digital identity? What is the role? Will it be possible to use a digital identity to identify these reporting obligations?
Well, maybe I can say something about that. And in principle, when you look at the reporting obligations for the sharing economy, and I shouldn't say sharing economy again, because as I said, this regulation ends up applying much broader than just the typical Airbnb and Ubers of this world. They end up applying to any type of business. And you think of a bank, for example, that in some line of business, whenever they adopt a platform model means connecting one person to a different site for a personal service or for a supply of a good or whatever. You have to think, for example, banks, they normally have these loyalty programs. So via the bank's app, you can, because of the amounts that you consume with your credit card, you can maybe buy products of a third party that you can see via the bank's app. And that would be, for example, a function of a bank as a platform. So this is not limited to the sharing the gig economy. For all those business, one of the key elements of these due diligence procedures is indeed, as you say, Jose, the validation and the digital identity. Because if you look at the DAC7 directive, they mention the possibility of platforms relying on government verification services, which is basically a software supplied by governments to help platforms basically validate the identity of their sellers. So if you just put the name, or you can check whether the tax identification number, it's accurate, and you could rely on that in order to conduct the rest of the due diligence. But the truth is that that's mentioned in the directive, but it's still not available to rely on by platforms in almost most of the countries. There is no such a service provided by government. So in the end, what platforms needs to rely on is on their own records and also on publicly accessible records, which is sometimes challenging, because you have to think that whenever a seller registers himself or herself at the platform, sometimes they could just miss one item of information, one wrong number in their tax identification number, or even purposely omitting certain type of information or just changing it and making it confusing. It puts already the platform into a huge burden of having to actually double check and make sure that the right information is supplied. So these government verification services, they are still non-existent, and there are initiatives, but as far as I'm concerned, they are not active yet. So that's a great problem in the DAC7 world.
Yes. You mentioned some implications of these new frameworks. Do they raise operational issues or challenges? If so, can you mention some of these challenges for the subjects?
Well, for what regards the perspective of DAC8 and crypto assets, one of the most important challenges is that of compliance for reporting crypto asset service provider, because the first risk is that this obligation will be too burdensome for all these reporting crypto asset service providers. And so there are some critics that argue that this reporting obligation could kill crypto asset service providers. And in my view, this is not completely true, because, well, first of all, the choice of the European Commission has been to use a reporting system based on aggregate information. So we will not have a transaction by transaction reporting, which should be, very burdensome, but we will have only a system based on the reporting of aggregate information, and this will be I would say, simplified compared to the traditional system, which is based on transaction by transaction reporting. So we'll have basically only reporting of information per type of transaction and per type of crypto assets, distinguishing between inward and outward transactions. And I think that because of this, crypto asset service provider will more easily manage this way of reporting information. Furthermore, I think that this is the moment also for all these providers to implement the proper technology tool to make all this process more simple, more easily managed. And also, I think that digital identity in this respect will be a great opportunity to simplify this reporting obligation, because it is expressly provided under DAC8 that when a crypto asset service provider implements digital identity to perform the due diligence procedure, there will be the possibility to collect less information, because the first name, the surname, and the name of the identifier of the user will be already enough information for tax authorities, as we will use the digital identity to identify this kind of customers. So digital identity will help crypto asset service provider, in my view, to make everything more manageable.
Yes, and what about intermediaries in scope? What about DeFi? You mentioned, Claudio.
Yeah, for DeFi, there is a big problem in my view, because the DAC8 provision exclusively impose this due diligence reporting obligation on centralized intermediaries, on crypto exchanges that are organized as intermediaries. So the big question is, what about all that kind of users that do not use centralized intermediaries because they prefer to use the centralized finance and, for example, performing transaction in a peer-to-peer manner, avoiding completely any centralized intermediaries? Actually, based on the DAC8 provision, we will not have this kind of situation covered, and therefore tax authorities will not collect any information regarding what happened in DeFi. And I think that this is a high risk for the effectiveness of the entire initiative. So there are some critics that argue, and I agree with them, that the DAC8 probably is a bit outdated, and that probably the European institution and also the OECD would have to focus more on the world of DeFi and to find a way into the technology itself to solve this issue and to understand more about this technology and to find a technical way before that a legal way to intercept all these transactions.
Yes, it may require a combination of technological solutions, regulatory adaptations, and of course, international cooperation. I think present a lot of challenges. Can you mention something more about the business impact and the compliance cost for this issue?
Sure, I mean, the business impact, as in every other regulatory initiative, businesses have reacted to these two regimes that were adopted by saying that it adds an extra layer of compliance to their business, right? And sometimes demanding them to get a bit out of their core business line in order to make sure that they report and they help the tax authorities in their function, right? So that, but without getting into the more political aspect of that claim, maybe in the field of DAC7, it's important to mention that in the EU, there is a big discussion about the efficiency of the directive, because if you look at other fields, for example, in the field of VAT, there are already provisions that somehow, for the sake of VAT, not income tax, DAC7 is more for the sake of income tax than of the sellers rather than a VAT, that they already cover somehow the transactions that are being covered by DAC7. There are also other regulatory initiatives, for example, for short-term rentals within the EU that are trying to actually streamline many regulatory regimes that have also reporting obligations, not necessarily for taxation, but you have to think for other regulatory purposes. So when considering all these different frameworks, there is a raising claim that indeed the directive and all, in light of all the rest of the regulatory interventions, could be make it more efficient in order to avoid overlaps and avoid double reporting of the same information in a different structure. So this efficiency argument is always put through. And of course, in the practical application of this directive, big platforms were already prepared for them, because basically they already have to comply with anti-money laundering and know your customer procedures. So they have them already in place, and somehow this directive meant extending those procedures to a new part of their business, right, to the sellers. But I think the big challenge was for smaller, or will be also for smaller platforms, that maybe they were not subject to those standards, and suddenly they need to face all these regulatory requirements that they probably did not have in mind when they launched their business. And it's especially relevant to mention that DAC7 does not provide like the minimum threshold for small platforms, because they consider that if you exclude smallest platforms, that you're giving them a competitive advantage over the biggest one. And also because in the end, it will be tougher for them to comply with when they start growing. So in the end, a very small platform in a garage, it's at the same positioning in relation to the rules than Amazon, Airbnb, or Uber. And of course, the resources of these two types of platforms are completely different. And when you think that you need compliance departments to be able to analyze these rules and comply them effectively, then you question a bit to what extent it was safe to also include really emerging businesses that do not have that infrastructure to cover those costs, right? And I think that when you look at the potential application of several regulatory frameworks with obligations of this type on small businesses, then you could argue that indeed there could be a potential infringement or to their fundamental rights because of how much burden it could be placed on them. There are many case law of the Court of Justice in the field of the sharing and gig economy. There are two cases specifically about Airbnb and its compliance with the Italian and Belgian regimes, which have concluded that this administrative cost and the fact that you have to incur cost in order to enhance tax compliance of your sellers does not amount or do not amount to an extent which will be a violation of property rights, for example, or the freedom to conduct business. But of course, one would question what would happen if instead of being a big platform, it's the smallest one that have to face these same costs. So at least that's in the world of DAC7.
Mm-hmm. And when the tax treatment is in many cases still unclear, how useful is to have tax reporting requirements? What do you think about?
In my view, it is very useful, even if the tax treatment is not still very clear, because I think from a logical perspective, tax information comes first. First, we need the availability of tax information. Then we think about the tax treatment. These are two different logical steps. It's like to think that we need first the water, and then we put the fish into the water. It's the same, just by analogy. So basically, today we are perfectly aware that there are still many doubts about the tax treatment of crypto assets, of certain kind of transaction like staking. But in the end, we still have to think more about the availability of tax information, and we have to see in a positive light that these initiatives from the OECD and the European Union, the OECD CARF and the DAC8 in the European Union. But in the end, we have also to keep a kind of critical outlook with respect to these initiatives for the reason that I mentioned before. These are a first step, but this is not enough because we need more, and we need to cover the world of DeFi. we need to cover the peer-to-peer transactions which are actually out of the scope of the DAC8.
Okay. Can you give us some point of view about sanctions and non-compliant operators? What about the enforcement or the effectiveness?
Yeah, an important element of both directives, the DAC7 and DAC8, so it applies both to the sharing, gig, and crypto economy, is the fact that these directives have extraterritorial effect. So they do not only oblige EU platforms or EU crypto asset service providers, but also those that are outside the European Union, but they either have EU sellers or they facilitate the rental of EU immovable property in the case of DAC7. So the way in which the system for platform reporting works is that in order to avoid duplicative reporting, basically imagine that if you have a platform in Brazil that already reports to the Brazilian government on all its transactions, and there is an exchange of information agreement between Brazil and the European Union, then the logic of this directive is that if you already demonstrate that you already report to your country of origin the same information that should be reported under DAC7, and that your country effectively exchanged that information with the EU, then it applies the so-called switch-off mechanism, which basically says, okay, you do not have to register nor report in the EU, and you will be able to report locally, basically. But when that's not the case, and let's say it's a platform based in China, and China does not have any reporting regime like this, or maybe it has one, but it does not exchange information with the EU, then that foreign platform should in principle register in one EU member state of choice. And the big question is, how do you enforce that, right? Because if you don't have agreements that would help you exercise extraterritorial tax powers or enforcement powers on these platforms, there are not many practical tools, let's say, to sanction them. And the directive mentions the possibility as a last resource to block the whole platform from operating in the EU. But that's a measure that in practice it becomes very difficult to exercise, because we all know that, and I remember this type of websites that would offer you the possibility of watching films, that they were sometimes struck down and they would appear the next day under a different name and under a different protocol. So I think the enforcement is indeed a big challenge for, at least from the side of DAC7, and I would love to hear Claudio also what are his views on the DAC8 part.
Yes, for sure.
Yeah, more or less, yes. I think there is the same point also from the perspective of DAC8, because we have to reflect on the fact that crypto asset users are usually high-skilled users compared to a standard internet user. I think that we can more or less agree on this, that if someone performs crypto assets transaction, probably he knows how to use the internet and the web in general. So if we will have some penalties from certain EU countries regarding, for example, the blocking of the IP address of a non-EU operators, crypto assets operator based in a third jurisdiction, third country, in the end, we are perfectly aware that a EU resident user may use a VPN service, a virtual private network service, to get access to a platform, and therefore circumventing the blocking IP measures adopted by his resident country. And so in the end, we perfectly realize that all these kind of measures are ineffective with this kind of high-skilled users. Therefore, the only solution, in my view, is to implement a more strict network of treaties, of cooperation agreements with the third countries, probably also to consider the multilateral treatment, so to cover the issue of administrative assistance, so to make possible that if a EU member state wants to enforce measures involving the block of a platform, a ban of a certain exchange platform to operate, that measure can also be implemented in the third state where that platform, where that exchange provider is based, because otherwise we will not have effective results for the implementation of DAC8.
And one extra thing that maybe it's worth mentioning, that there are some research on other in another field in the digital service taxes, for example, in the UK, that in the digital service tax regime of the UK, you also had foreign taxpayers, non-resident taxpayers that need to register in order to comply with that tax. And the experience has shown that somehow when it comes to big platforms that have an important role in the market and an important brand and name, the lack of, let's say, practical enforcement tools does not matter at all, but because in the end, because of the reputational pressure that these foreign platforms have to comply with the regimes and in order to avoid being exposed in the media as non-compliance, the experience shows, at least in relation to the UK DST, that like the great majority of foreign platforms have registered themselves and comply voluntarily. But I think that the issue, and that issue, I think the same logic can be transferred to the DAC7 and DAC8, I think, realm. But the thing is, okay, but what about those smallest platforms that maybe they have a different strategy, that they do not care, more violent moves into a certain market, and they are not that much concerned about their reputation, right? How do you enforce on them? So I think that we'll see more on that on the forthcoming years, also on how you could improve this, as Claudio said, this administrative cooperation among countries.
Well, thank you, Claudio and Juan Manuel. I think it's essential to know deeper about this topic because compliance officers plays a key role in understanding the requirements of these policies and translating them into concrete steps for the company. I see some key points for compliance officers, like assess the potential risk associated with non-compliance with tax law in the digital economy. I think they should analyze the impact of DAC7 and DAC8 on the company's operations and identify areas of potential non-compliance and develop strategies to mitigate those risks. I think another key point is in internal controls, because compliance officers, I think they should establish and monitor internal controls and procedures to ensure compliance with tax reporting requirements. And I think despite of training and awareness and reporting, I think there's so much to do because compliance officers can foster a culture of compliance, promoting ethical behavior, integrity, and transparency in all tax-related activities. I think they can provide guidance and support to employees and a proactive approach to this topic or topics like this. So I appreciate so much if you can make a conclusion or a few words to close this episode.
Sure. Maybe on the DAC7 side, DAC7 came into force on the 1st of January 2023, so it's currently into force in the EU. The first reporting deadline is on the 31st of January of 2024, so we are almost there. We have 6 months to get ready for this, and for many companies, this is not enough time, and they are already aware that they are in scope. But I would strongly suggest, if your business somehow uses a business line in which it connects clients with other parties, which could be even related entities of your own company. So imagine, for example, if you are a multinational that hires the services of a third party by a different entity of the company, those type of triangular situation or multi-sided situations within a business can trigger DAC7 obligations. So I would first say, look it carefully. DAC7 is not only about sharing economy platforms, it's also about incumbent firms or traditional firms that have a multi-sided business model. And as soon as you detect whether you're in scope or not, then get ready to comply, to collect the information, to validate it. And if you are not already doing so for AML and know your customer purposes, then you will have a great burden to start doing this fast, because DAC7 is coming. And then you will enter into all the compliance details and depending on the member state in which you register, the interpretations. So the sooner the better. And if you, of course, both Claudio and me, we are happy to discuss this topic. We love them. We love the topic. We're very close to them, and it has several edges. So, but in a nutshell, will be that, like, act soon and make sure that you are in scope or not, and if you are in scope, that you are ready to comply by the 31st of January.
Thank you, Juan Manuel.
From my side, for what regards DAC8 and the crypto assets world, reporting for crypto assets, we have a bit more time because the new provision will enter in force in 2026, from the 1st of January 2026. So in the meantime, my suggestion, recommendation for crypto assets operator, for legislators on the other hand, are the following. For crypto assets operator, I would suggest them to pay attention and to see digital identity as an opportunity to simplify their internal processes, because if they are going to implement a digital identity system provided by their national government within their platform to identify their customers, they are going to definitely simplify the reporting obligation and they will have to collect less information with a certification. For what regards the legislators, my suggestion is really to focus in the next couple of years more on the way to build a network of cooperation agreements with third countries that could be effective and that could ensure the enforcement of the measures of DAC8 in third countries in case of no new operators.
Well, thank you, Claudio. I think this episode left so much information and hot topics to discuss. Thank you again to our guests, Juan Manuel Vázquez and Claudio Cipolla. And that's wrapped up our episode for today. I wanted to take a moment to thank each and every one of you for tuning and listening our episode. If you've enjoyed this episode and want to hear more, subscribe to our podcast to receive notifications about new episodes. Additionally, if you know someone who might be interested in this topic, please feel free to share this episode with them. We would also love to hear your feedback and opinions, so don't forget to leave us a review on the podcast platform you use or our social media channels. Finally, don't hesitate to visit our website to reach information about memberships, activities, further events, dates, and more. Well, thank you, Claudio and Juan Manuel. Thank you for joining us.
Thank you very much, Josefina. It was a great pleasure.
Thank you very much for all. Thank you. Bye.
Well, that's all for today. I'm Josefina Maggiari, and this has been our last episode. Thank you again for joining us in this episode, and I hope you've enjoyed it as much as I have. See you next time. Take care.